Thank you for joining me for a short video describing the stock valuation model. I'd like to kind of walk you through the model, give you a general understanding of what it consists of and how easy it is to use and what it can do for you. The stock valuation model calculates a free cash flow valuation as well as a PE valuation, and then provides you a blended version of the two. Calculating the value of a stock is as simple as entering the ticker symbol. So in this case, let's enter WMT, which is the ticker symbol for Walmart. In a matter of seconds, all the financial information about this company is imported into the model. As you can see, the Walmart is imported, but these are stuff that's coming directly off of the various financial statements in terms of values that are used as part of the valuation model. We have all the income statements for the last 5 years, both the annual as well as the quarterly information, balance sheet, cash flow. And we also have quoted information, various quote information about the company, and analyst growth forecast. So then, once you've got all that information imported in, all you need to do is vary the value drivers. And what I've done to try to make things simple for you is using historical financial valuation, I've calculated the 5-year, 3-year, and 1-year historical averages. What you're looking for is companies that are growing very consistently, have a very consistent business model. In this case, you can see that Walmart is very consistent. It has a net operating profit of about 5.9%, net investment varying from 1.8 to 1.2, so fairly consistent there. And working capital, change in working capital is also very consistent, between 2.1 and 1.8. So this is your very predictable kind of company that you strive to find. Ideally, one that is predictable and growing at a decent clip. This one is growing at around 9 to 10%. Very consistently, it's been growing about 9% a year. If analysts are forecasting 10%, yeah, it's probably a little optimistic based on the historically, but you could do your own research and come to your own conclusion on that as well. So what you would do is I typically use 11% as my discount rate, and I would, for blue chip companies that are very dependable, very consistent business model, I would drop that down to 9%. But typically for your average small cap kind of company, I'd make it 11% as discount rate. And I describe all these value drivers in my material that comes along with this model, and give you a description of how to use it and the calculations behind both the discounted cash flow and as well as the PE valuation, as well as some reference material that you can go dig into if you prefer some additional information. But everything you need comes with this model. So based on the historical tax rate, you can see it's somewhere around 33% a year. So there's really that's an easy one to forecast. So you should expect around paying 33% tax rate. P valuation or P ratio historically has ranged from 14.9 as your average over the last 5 years. It's at a low right now of around 13.1. Let's be somewhere in the middle. We'll say 13.5. I hate to be too optimistic. And then for net operating profit margin, that's 5.9. It's pretty consistent, so you ought to be pretty safe with that, unless something drastically might change in terms of the environment that this company is playing in. But it's pretty consistent, so I'd use 5.9 there. Net operating margin, or net investment margin rather, ranges from 1.8 to as an average to 1.2, which is the current. So it seems like it's trending down, but why don't we put it at like 1.6? That's somewhere in the middle. The higher the number, the more conservative you are. So if you're pessimistic about the future or you're just concerned and you want a very conservative valuation, you don't want that to be more on the higher end. And then change working capital. This one doesn't seem to drive. 2.1%. This one doesn't drive the valuation too much, but it does have some impact. But the two most sensitive ones would be the net operating profit and then the net investment margin. Both of those are used along with the free cash flow or the tax rate and the change in working capital for the free cash flow model, and then the P ratio. Obviously, the P is used for the P valuation model. So based on what we have here, and if we put 10% in as the growth rate, which is what analysts are saying, it gives you a price, the intrinsic value of around $70 a share for the free cash flow, and $74 for the P valuation, and then a blended value around 71. I typically decrement this the analyst forecast by at least 1% or so, because they tend to be pretty optimistic, and you can see historically it's only been growing about 9%. So if we put 9% in there, which is probably a reasonable forecast, you can see that it's worth, we believe the model thinks it's worth anywhere from $64 to $68 a share. It's currently trading at 62, so it's getting close to its fair value. Not quite there if you look at it from a blended perspective. So this one is, it's not drastically it's not overpriced, but it's not drastically underpriced either. So I typically wait for a stock to get to the a price that would allow me to make 15% return. And so in this case, I'd have to wait for the stock to hit somewhere between 37 and 40. On a blue chip kind of stock, I might vary that a little bit. I might say, well, this is a low risk investment, so let's lower my required rate of return. So if I change my desired rate of return to 12, you can see that those 15 changed from 15 to 12 here, and it's basically telling me the price I would need to wait for it to get to in order to get a 12% return. In this case, somewhere between $48 and $52 a share, so a blended value about 50. So I would hold on this stock. I wouldn't be selling it at the moment, but I wouldn't be buying it either. So it gives you this is a great tool to give you an approximation of the value of a stock, and make sure you don't overpay for a stock, and allows you to put together some excellent watch list based on the valuation of a stock, taking all the emotional side out of it. So appreciate your time. I hope you find this useful and make use of the model. Thank you very much.